We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. You can always go to the website to learn more, deckerretirementplanning.com. And I start every week we do this program, I always start with the opportunity that you have to learn more about some of maybe the questionable areas of retirement and the financial world that you're not really sure about. I always send you to the website, deckerretirementplanning.com. And then under the heading of Safer Retirement Education, there are 12 different things you can download, no cost to you, no strings attached. I think a great place to start is just get Brian's book. Just download it right there. Decker Approach book is available. So it's Brian's book on retirement, really talking about the process that they use with their clients at Decker Retirement Planning. There's 3 principles of retirement book, the checklist challenge, sample income plan. Those are 4 of the 12 things you can download. No cost to you. deckerretirementplanning.com under the heading Safer Retirement Education. You can always use that website to find out where they are, different offices in different areas, but you can also find out about events that are upcoming that maybe you'd like to attend. Some are for clients only, some are for prospective clients, some are for just educational purposes. deckerretirementplanning.com. I'm Mark Elliott. Glad you're with us today. Brian and Arrin are going to cover a lot of ground today, and if you have questions, you want to sit down and maybe see how that pertains to your situation, all you have to do is give them a call. There's no cost for that either. It's 833-707-3030, 833-707-3030. All right, Brian J. Decker, where are you and Arrin going today?
We're going to talk about timing of retirement versus the markets. And Arrin, we'll talk about the risk of preparing before retirement. And after, I want to tee this up for you, Arrin. So the first thing we want to talk about is how frequently people think that the same way, and I'm going to use the mountaineering example, the same tools, strategies that you plan to get up to Everest are the same tools, strategies you use to get down to Everest. Interesting factoid. Gosh, I can't remember what the exact number is, but it's pretty close to 88% of casualties on Everest are not going up the mountain. It's coming down the mountain. And the parallel really is true in retirement planning. Accumulation planning is different from distribution planning. Accumulation planning is where in your 20s, 30s, 40s, 50s, you've got your 401k, you've got Roth, hopefully, Roth opportunity. You max your 401k, you invest it wisely. Markets drop 30, 40, 50%. No big deal because you're putting money every 2 weeks into your 401. So your dollar cost averaging into a declining market. Your income is not coming from your 401k. Your income is coming from work, and you've got time, T-I-M-E. You've got time for the 3 to 5 years for the markets to recover. And in fact, you benefit from a market decline. That is during your accumulation years. During your distribution years, you've retired, you're 65, and now your portfolio provides you income that your job used to. Now your portfolio drops 30, 40, 50%, and you draw income from that, and that is an entirely different game. Entirely different. Accumulation strategies, banks and brokers are very good at that, but there's a different set of rules for retirement. That is what we specialize in. Now, I had a knee surgery, I had a knee replacement actually a couple years ago. I didn't go to a dentist. Dentists are great people, very well trained to do what they do, but they're not trained to do what I needed them to do. I went to an orthopedic surgeon specializing in knee replacement. We specialize in retirement planning, and we'll give you some examples of how, in this radio show, how different it is. So, Arrin, the first thing let's talk about is, let's say you're 5 to 10 years in front of retirement, and the markets take a 30, 40, 50% drop. Let's even narrow this down more. Arrin, let's say within 5 years of retirement, What should people start doing? Let's have that be the second question. And you answer the first question. This is easy. This will take one sentence. What happens to the people who within 5 years of retirement see a market drop in their 401k of 30 or 40%?
You typically have to work a little bit longer. So a lot of people see that big drop and realize that the asset base that they thought they had isn't there anymore. Now, it depends on how long the market recovery takes, right? But it can be pretty scary if you're gearing up for retirement and all of a sudden you have 30 to 40% less than you expected.
So let's say that typical retirement is 65. So within 5 years of retirement, what should people do? Let's go through the whole list.
Sure. So as far as market exposure, you definitely want to start tailoring that back. It's always a difficult conversation when I have somebody come in and say, hey, I'm gearing up for retirement. I'm planning on continuing to just leave my funds invested in my 401k. I'm in a high risk or high growth type fund. And then the next year, all of a sudden, market took a 20%, 30% drop, and they don't really have the same retire date anymore. It's one of those things where there's a gamble, right, in leaving it invested where the market could perform well, market could perform poorly. And our approach is to not just leave that up to chance. We want to make sure that you are ahead of time making plans for and adjustments for those investments to make sure that when it comes time to transition into retirement, that can be a smooth transition for you. Not going to have any things catch you out of left field. And so definitely dialing back the amount of your portfolio, percentage of your portfolio that's exposed to risk or volatility can really help not only alleviate those concerns, give you peace of mind, but also make sure that you can retire on time if the market decides to kind of go into a choppy cycle or just take a big dump before you plan on retiring.
Hey, Arrin,
So-
I was thinking that before you dialed it back, step one, let's get a plan together. And then based on that plan, dial it back, right?
Yep, absolutely. Yeah, it's something where unfortunately a lot of people don't have good information to go off of. Unless you've been trained in it or just happen to have done a ridiculous amount of research, I feel like the financial education for our general population isn't great. And so a lot of people just do the best they can with what they have, where they just kind of go, hey, I'm getting a little bit older. General financial rhetoric says as you get closer to retire date, you should put more and more of your portfolio into bond funds. And so that's what I'm going to do. And so we have a lot of people that take that approach, and especially the last 2 or 3 years, that's really hurt some of the people that I've had conversations with, where 3, 4, 5 years ago, they had their advisor or themselves put them into anywhere from 40 to 70% bond funds to quote unquote be more conservative. And then we had that dramatic interest rate spike that started into 2021 and has continued till now. And those bond funds that they thought were going to protect them from market volatility were actually a big cause of the loss in their portfolio. So a lot of those bond funds were down 10 to 30%, depending upon the specific one, on top of the drop in 2022 that happened from a stock or an equity-based portfolio standpoint. So not only do you need to make sure that you are adjusting risk-wise, you need to make sure that you're using the correct vehicles. And to your point, Brian, you want to make sure that you're doing it math-based, where it's not just guess and hope for the best. I think this might be okay. Let's just see how this works out. You want to make sure you know why you're doing what you're doing, exactly how much either percentage-wise or dollar-wise is going into these specific categories, and what the purpose for each of those investments is. And that's something that we're very good at here at Decker Retirement Planning. We're a math-based firm. We're a numbers-based firm. We can show you exactly, based off when you're going to retire, your asset base, all of those other variables, where to allocate that money, how much should be exposed to risk, how much needs to be in protected accounts. And that can really help you gear up and have a smooth transition when you do finally pull the trigger and actually retire.
Let's talk about what happens if, let's say you're within 5 years of retirement. So option A is to do nothing, take the hit. Now you're right. Your retirement is pushed out. I saw this in January, February, March of 2000. I saw it January, February, March of 2009 when markets took that big hit in 08. people's retirement were pushed out. Some people by many years. If you don't prepare for retirement within the last 5 years, you're taking a risk. I remember that Dirty Harry. Do you remember, Mark, you're old enough. Do you remember the old Dirty Harry Clint Eastwood movies
Sure.
where
Yeah.
he got into a gunfight and there were bullets flying everywhere? And finally, Dirty Harry's got his boot on the guy's neck and he's got his big gun right in his face and says, in all of that fracas, or maybe I shouldn't say fracas, in all of that gunfire, I can't remember if I shot 4 shots or 5 shots. The gun holds 5. Do you feel lucky? And so I hope that people don't do that and gamble with their retirement. I hope that they do the planning, that they're proactive, that they're focused and determined not to allow the market to take away their planned retirement years. And so within 5 years of retirement, step 1, make a plan, book an appointment, come in, and we have not a pie chart for you. Arrin, talk about in detail over the radio so that people can picture what they would see when they come in. We're a math-based firm, so of course our distribution plan is like a big spreadsheet, but it does many things. So Arrin, take us through what the planning would entail.
Yeah. So the first version of, we call them income distribution plans, the financial plans that we build for our clients, they are designed to help you see where all of your money is invested, how much income that can provide for you over time, and to build in all of your assets and income streams, pensions, Social Security, all of that stuff in addition to it. And so from an investment standpoint, we typically break out the funds into 3 main categories. We have an emergency cash account. We want to make sure you have something for unexpected expenses. Second, we have those principal guaranteed accounts. This is the safe portion of the portfolio. So this is where you're going to have a lot of protection against the market drops, the volatility, and it's really where we hone in on the vehicles that are going to both protect the funds and provide income for you at the point in time that you do retire and start taking distributions out of those accounts. And then the third portion is going to be what we call your risk bucket, risk portfolio. And this is going to be the portion of the plan that still has exposure to the market. These are going to be stock and equity based investments with the goal of providing a higher return over a longer period of time. And so instead of, to your point, Brian, instead of just having a pie chart where we lump all the funds into one big bucket, just say, hey, what's your risk tolerance? Allocate the funds according to that. We diversify the funds by purpose, by what you are going to use them for and when you are going to use them. So again, the purpose for the funds changes from pre-retirement to post-retirement, where it's not just about building up that nest egg, seeing the number go up. It's more about utilization, deployment, how you're actually going to use that money that you've worked so hard to build up and accumulate in that nest egg. So again, we have that emergency cash, the principal guaranteed accounts, those safe investments, and then the risk portfolio. And we use those accounts to provide an income stream in addition to Social Security, rental income, pension, anything else that our clients have as far as outside income sources. And so again, based off of our math-based approach, we have the ability to show you exactly how much should go into each of those categories. And then based off of that, your other income sources, your lifespan, we can show you exactly how much money you should be spending every year to both maximally spend, but also make sure that you don't run out before you pass away. I love our spreadsheets because you're able to see all the numbers, you know exactly why we're doing what we're doing. And if there's any tweaks or adjustments that need to be made, we can have the conversation now versus later when it may become a problem for you.
So it's an opportunity, certainly, to call the team at Decker Retirement Planning. It's 833-707-3030. And you're like, wow, I don't have anything like Arrin just described. Or, hey, that sounds really interesting. I wonder how that would work for our situation. Just give them a call. Find out. That's what they're here to do, is help you figure out where you are, give you some clarity into your retirement picture. Again, at no cost to you. It's 833-707-3030. 833-707-3030. Brian and Arrin back with more of Safer Retirement Radio right after this. Stay with us.
You have enough things to worry about. Market volatility shouldn't be one of them. Make sure your retirement plan doesn't rely on the ups and downs of the market. Call the Decker Retirement Planning Team to get started at 833-707-3030. That's 833-707-3030.
Uncle Sam might need a loan soon from you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. I always say every week, go to the website, DeckerRetirementPlanning.com, because if you're trying to learn and gain more knowledge about retirement, some of the challenges that we all will face. But really, there's so much more we have to do in the retirement years than we did during our working years. It's kind of crazy to think about it, but your paycheck is on your shoulders. Where's it going to come from, unless you're lucky enough to have a pension? Social Security certainly would be one form, but where else is your income going to come from? Your investments, now you're not paying in like you were during your working years to that 401k. Now it's just pulling money out. And the biggest fear is people fear that they will run out of money before they run out of life. So investments on your shoulders, taxes on your shoulders, health care, long-term care, it's on you. Legacy planning, how you can leave it. And then you have Social Security, Medicare decisions. It's all on you. So Brian and the team really could kind of be, in a way, your chief financial officer to help guide you. Hey, here's Tom, Betty, here's what we think are maybe the three best choices for you in this area. Which one do you like? Which one are you most comfortable with? Because at the end of the day, it's about you making the decisions for you and your family. Brian and the team are here to help guide you. And then you make the final decision at the end of the day. 833-707-3030 if you'd like to talk to them. 833-707-3030. But if you go to DeckerRetirementPlanning.com, there's 12 different things you can download, including Brian's book on retirement, The Decker Approach. There's the 3 Principles of Retirement book, the Checklist Challenge, the Sample Income Plan. Those are just 4 of the 12 things you could download right off their website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. Just a great opportunity for you to learn more. All right, Brian, talking election, and certainly one of the crazy things about elections is people do get super caught up whether their candidate wins or loses. Well, you and I have been through a lot of elections. We've been, a 4-year period with a Democratic president, 4 years through with a Republican president. I mean, at the end of the day, I suppose certain areas it might matter, but overall, does whoever win the White House, does that really affect our everyday lives, do you think?
Well, at least the stock market says there's not a big difference. So going back to 1940, this information was gathered by whoever owned the White House and both sides of Congress. So that's the House and the Senate. When a Republican owned all three, that happened over specific period. Gosh, Mark, I think it's like 16 years. And then the Democrats have done that over twice that period, like 30, 32 years. What were the rates of return on the S&P during those periods? It is exactly the same, almost to the decimal. It's really interesting. Almost exactly the same. And now if you split it, going back to 1940s, whoever was in the White House.
That would be Franklin Delano Roosevelt, who had defeated Republican Wendell Willkie in 1940 for his unprecedented third term. And then he would win again in 44, but he passed away in office. And then I think that's Truman takes over. And then Truman wins the next election. And it was Dewey wins election, and Truman's got the picture of him with the Chicago headline saying, Dewey wins, and obviously Dewey did not win. But there you go. 1940 was Roosevelt winning his third term in office. He's the last one to ever get to do that. Served 3 and 4 terms.
So the first study was what were the returns when Democrats owned all parts of politics? So the White House, the House, and the Senate. And then so those numbers are exactly the same to the decimal. And then if you look at the returns of who's in just the White House, forget about who's in the Senate and the House, the Democrats have averaged a rate of return of about 9.3, and the Republicans since 1940 have averaged 10.1. Again, very, very close. So this country is very, very divided right now, more so than ever in my lifetime. Mark, have you ever seen it like this?
In the 60s were a tumultuous time because we had a lot of race factors back then. And down south, it was kind of crazy and out of control. So, early on in my life, I was born in 1959. So the 60s were pretty wild. And you had Vietnam, you had all that going on. And it was, you had the hippie group that were against the war in Vietnam and all that. There were some crazy times, but I think you're right. I've never seen it this divided.
And I think it has to do with whatever news feeds you're tapped into, it paints your view, your worldview of things. And so the Republicans think the Democrats are horrible, and Democrats thinks Republicans are horrible. It's very, very divided right now. But as far as the markets go, very, very close. But the ideal outcome for the markets is gridlock, where whoever is in the White House, you have the opposite parties controlling Congress, checks and balances, which our forefathers geniusly put in place. That's the ideal situation for the markets. Now, the portfolios are different. So if Trump gets in, there will be an emphasis on energy. So the crude oil, the natural gas companies, the pipelines, the transports, those companies will be emphasized. If Kamala Harris gets in, then it will be the green energy companies that will be highlighted in portfolios. That's what I'm reading and hearing. But there's expected to be a lot of volatility. Volatility is just where the markets go up and down. Already, I'm reading. Mark, I wake up at 3:30 in the morning. I hit the research. We have a 6-figure research budget, and what I'm reading is you buy the dip. Whatever passion, emotions sell the markets off. If that happens, a lot of smart people are going to buy the dip. Now, it's kind of nerve-wracking to see Warren Buffett. He's got a record cash level, which right now is, I think, around $360 billion. It's never been that high. He's a very smart man. And what does he know that no one else knows? He's never had this much cash. It looks like he's expecting or anticipating, a lot of market sell-offs, or maybe he just doesn't see a lot of value right now in the markets. But want to spend time on, in retirement, how your portfolio should look different. So, Mark, tell me if this is common sense. You, in your 20s, 30s, 40s, 50s, you're putting money in your 401k every 2 weeks. If the markets go down 30, 40, 50%, no big deal, because your income is coming from work. And every 2 weeks, you kick money into a down market. And so you've got the 3 to 5 years for the markets to recover. You've got times on your side. And so in 3 to 5 years, when the markets do recover, you're better off because you dollar cost averaged, you bought into a down market in your 20s, 30s, and 40s. That's called the accumulation strategy. That works. However, once you're 60 plus, let's say you're 65 years old, Mark, and now your income is coming from your portfolio. If that portfolio is down 20, 30, 40, 50%, and you're drawing income from it, that is lethal. That will send you back to work. Millions of people had that happen to them in 2008. So there's several things going on that we want to talk about here and how to protect yourself. One, and I guess there's 6 key things that is worth writing. These are worth writing down. If you're in a car, don't write it down. Pull over, make a mental note, or go and listen to the radio podcast. You can dial it up at Safer Retirement Radio. That's where you'll find this saved. So these 6 key points are, if you're writing them down, we'll have time to cover just the first point in this first segment, but the 6 key points to a final retirement plan are: number 1, to have a plan. Most people don't have a plan. We're going to talk about what a retirement plan actually is. Number 2 is risk reduction. You should have far less risk exposure in retirement than you do in your working years. You can handle down markets during your working years. You cannot handle those if you're drawing income from a fluctuating account. We'll talk about that. Number 3 is tax minimization strategies. Number 4 is portfolio optimization, making sure each part of your portfolio is optimized. We'll talk about that. Number 5 is having the focus on maximizing your net of tax monthly income during your retirement. And then number 6 is fee minimization, making sure that your fees are much less than what the average person pays in the United States. So the first thing, the number one fear of people in retirement is running out of money before they die. And Mark, I got to believe it's because the bankers and brokers tell you to look at a pie chart and that's your plan. And nobody can look at a pie chart and see how much money you can draw for the rest of your life. So time and again, we see them underdrawing their portfolio because they're afraid to draw what they could because they don't know what they could draw. They're very happy to come in and see an actual retirement plan. We call it distribution plan. The strategies that got you to retirement are not the strategies you use in retirement.
Yeah, so you think about all the things that are going on and things that can affect your portfolio. We know COVID certainly did, right? The markets dropped like crazy, like 35% in a 5-week period, but they came back really fast. And so when you get through elections, there's always a little bit of people are unsure if that was the right decision or not, and how is that going to affect your portfolio. So you got to have strategies depending upon the winter and all of that. But Brian and the team at Decker Retirement are here to help. All you have to do is give them a call. There's no cost, 833-707-3030. This is totally complimentary. It's just a great time for you, I think, to get some clarity into your retirement picture. 833-707-3030. Back with more with Brian J. Decker on Safer Retirement Radio right after this.
In the world of taxes, knowledge is power. Let the team at Decker Retirement Planning empower you with the insights and strategies needed to navigate the complexities. Dial 833-707-3030 to stay ahead of the tax game.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott again. If you have questions, you have concerns, 833-707-3030. Can we retire? I think we've got enough. I think we're going to be okay. Why wouldn't you find out? Get some clarity into that retirement picture of yours. 833-707-3030. This is totally complimentary, no cost to you. There's no pressure. There's no obligation. There's no judgment. You're good to go or you're not good to go. And if you're not good to go, how do we put you in a position you can retire? 833-707-3030. So you were talking about the 6 different areas. Number 1, having a plan, but it's about optimizing after tax money and it's all kinds of things. So you were just getting into that. You're starting with the first point of having a plan, which most people do not have a plan. They might have that pie chart, or they might have had, hey, just pull money. You need some money, just call us. Your stockbroker will just send you some money. Those really aren't plans. They're not the plans that you're talking about, Brian, that your team does at Decker Retirement. So having a plan, maybe expand on that a little bit and then get into the other 5 you got.
Okay, a distribution plan is quite different from a pie chart. A pie chart is an accumulation plan that you'd use to get you to retirement. A distribution plan is a retirement plan you use once you are retired or within a couple years of retirement. A distribution plan looks like this. It's got your age. Top left, we plan to age 100, not because we expect you to live that long, but in case we want to make sure that your money outlives you. Then we've got your sources of income. We show your Social Security. We show your pension. We show your rental real estate. We show your portfolio income. And we total them up as gross income minus taxes and that gives annual and monthly income with a COLA, cost of living adjustment, to age 100. Clients love it. They absolutely love it. Mark, they can see how much they can draw with very, very conservative estimates on growth rates. And then on the right side of the plan is their portfolio. We have laddered principal guaranteed accounts. We have a money market account, cash for their emergency cash in bucket 1. We have a 3-year CD, a 5-year CD for buckets 2 and 3. Then we have principal guaranteed accounts. These are variable rate investments that are averaging about twice what the CD rates are. And then we have the risk bucket. Now, that describes the distribution plan. When you draw income from a pie chart, you're drawing income from a fluctuating account. Mathematically, and we are a math-based firm, mathematically, when you draw income from a fluctuating account, you compromise gains when markets go up, you accentuate losses when markets go down. And it works until it doesn't. And when it doesn't, it's very inconvenient because it will send you back to work. And so we want to make sure that clients draw income from laddered principal guaranteed accounts. 2022 was a great litmus test. S&P down 19, NAS down 33, bonds down 20, commodities were down across the board. Our buckets 1, 2, 3, 4, and 5 actually made money because buckets 1, 2, and 3 are fixed rate. They made money no matter what the markets do. And buckets 4 and 5 are principal guaranteed. All those first 5 buckets are guaranteed, didn't lose a dime, made money. And then the risk bucket we'll talk about in a second. Those are strategies that are able to make money in up or down markets. They're designed to make money in up or down markets. They're momentum strategies. In 2022, there was one sector of the market that made money in 2022, and that was energy. Russia had invaded Ukraine, and that year we had the crude oil companies, the natural gas companies, the frackers, the drillers, the pipelines, all made very good money, 15 to 20% when most people lost 30%. So we want to make sure that you're using the latest technology in retirement. Momentum strategies buy what is going up. We'll talk more about that when we talk about optimizing your different parts of your portfolio. But point 1 is to have a plan. Most people don't have a plan. Hope you have a plan. That's point number 1. I've swerved into something, Mark, that I just want to finish, and that's a thought that accumulation strategies will hurt you in retirement. Buying bond funds in a rising interest rate environment is not a good idea. From 1940, the 10-year treasury was at 2%. And then 40 years later, in 1980, it was almost 15%. Whoever owned bond funds in a rising interest rate environment loses money. Then from 1980 to 2020, 40 years of declining interest rates, they dropped to a low of 0.47 in August of 2020. And since then, interest rates have been rising. You do not want to own bond funds in a rising interest rate environment. In the last 4 years, bankers and brokers have told you that your safe money are in bond funds. Well, those bond funds have lost over 30%. And that is basic. It's financial malpractice to own bond funds in a rising interest rate environment. There's much better options for you in retirement. So that's strategy number 1 that you don't do in retirement. Number 2, you have much less risk reduction in retirement. Your exposure to the stock market should be much less in retirement. Our clients have about 25% of their portfolio exposed to the markets, not these ridiculous 60, 40, 70, 30 portfolios we think are insane to have that much of your portfolio exposed to the market, especially now. Now, the stock markets have changed quite a bit. There's been 4 times that the S&P 500 has traded above a market valuation of 30 times trailing earnings, 4 times. One was 1929, and markets were flat for 17 years. Second was 1964. Markets were flat for 18 years. The third was November of 99. Markets were flat for 14 years. The fourth and final time was November of 2021. We hit 32 times trailing earnings. Goldman Sachs is out saying that the next 10 plus years are going to be low single digits in rates of return. So with history being 100% behind us, we are expecting, hoping for the best, but we're expecting the next 10 to 15 years being a flat market cycle, which is devastating for people in retirement that follow banker broker advice to buy and hold, which is a passive investment strategy, buying and holding stocks, mutual funds, indexes, or ETFs. Those will yield a zero return if history repeats. So a momentum strategy, this technology has been around for 30 plus years. This is where you buy whatever is going up. Every stock is scored or ranked 0 to 100 based on price appreciation and volume. It's based on relative strength. And momentum has you buying the top relative strength stocks until something better comes along and you rotate into the better option. It is sector rotation. It is relative strength, and it is pure momentum. So for example, in 2000, 01, and 02, when the S&P was down 50%, NASDAQ down 70%, there were many sectors of the market making good money. That was the real estate through the REITs, gold, silver, energy, pharmaceutical, biotech, healthcare. All those stocks were making double-digit returns when most people lost half their money. Then the markets bottomed in March of 03, and what exploded to the upside for the next 4.5 years were technology, semiconductors, small caps, and emerging markets. Then rolling into 2008, it was a waterfall decline where everything went down. So there are stop losses in place. Momentum only buys things going up. And if there's nothing going up, you're moved into cash. Everything went down except for one thing. That's treasury bonds. Treasury bonds were up 22% in 08. So you own some treasury bond exposure. That is how momentum works. It cherry picks the best parts of the market when the markets go up, and it seeks out and buys into whatever is going down in a down market. In 2022, that was energy. So that is part of how strategies change when you're in retirement. So first off, number one is to have a plan. Number two is risk reduction. We've touched on this. In your 20s, 30s, 40s, 50s, buy the indexes, hold on, be aggressive. But once you retire, you can't make up for these big losses. So we don't recommend that you have these 60, 40, 70, 30 portfolios. So there's three parts to risk reduction. One is quantitative. Quantitatively lower your exposure from 60 or 70% down to 25. Second is strategically lower your risk. Employ risk strategies able and designed to make money in up markets and down markets using momentum. And third is eliminate interest rate risk. Do not buy bond funds. So those three things are three ways that we dramatically lower clients' risk in retirement. So number one, we have a plan. Number two, we employ significant risk reduction strategies. Now, number three, we employ significant tax minimization strategies. These are strategies that help clients dramatically lower their taxes that they pay. Now, one of the best ones that is broadly beneficial is the Roth conversion strategy. So the Roth conversion is where there's 35 trillion reasons why we expect tax rates to go higher. And if you believe that, how smart are you to proactively pay taxes now on a portion of your portfolio so that growth can be tax-free? There's a side-by-side comparison here. I told you we're a math-based firm. Here's the numbers. Imagine a 60-year-old with $1 million IRA growing at 6% a year, dutifully at age 73, pays his required minimum distribution taxes. We killed him off at age 90. How much tax did he pay? Well, he paid $676 and change, $676,000. But wait, there's more. With the Secure Act recently passed, it gives 10 years for the beneficiaries of that IRA to pay the rest of the taxes. That's over $718,000 more, for a total of almost $1.4 million. Now, Mark, this is what is sickening. a 30 years of 6% growth on $1 million IRA, the net of tax transfer after 30 years of growing at 6% is a measly 1.2 million, 223,385 to be exact. That is horrible. In fact, the IRS got more than the net value transferred to the beneficiaries. The IRS got 1,395,228.36. That's horrible. So what we want to do is proactively pay taxes now. So at 60 years old, say $1 million IRA, we're proactively going after it. We convert 225, and then 50,000 a year, so that by age 73, there's no IRA left for required minimum distributions. We killed him off at age 90. How much tax did he pay? Did he pay 1.4? No, he paid 319,474, 1.1 million less in tax. Did he transfer 1.2 to his kids? No, he transferred 4.1 million. The Roth conversion strategy is by far the most beneficial tax strategy and the most widely beneficial, benefiting the most amount of people.
So obviously, if you'd like to learn more about that, how does that really pertain to you and your situation? It's all different. It's all relative to whoever Brian and the team are sitting down with. And obviously, sometimes it makes perfect sense to roll money into the Roth, and sometimes it doesn't. But Brian and the team don't know until you reach out and talk to them. This could be a great thing for you, but then again, maybe it's not right for you. Don't know until you reach out. 833-707-3030 is the number. Again, no cost to you whatsoever. 833-707-3030. And it's really about figuring out what's right for you. What makes the most sense for you and your family? Brian and the team are here to help. 833-707-3030. So we're about halfway through that distribution planning process. We got 4 through 6 steps to get to when we come back. Back with more with Brian J. Decker of Decker Retirement Planning right after this.
Crafting your legacy is like planting seeds for a future forest. Let's nurture your vision together. Speak with Brian and the team at Decker Retirement Planning at 833-707-3030 to ensure your legacy grows strong.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Again, you can always go to the website, DeckerRetirementPlanning.com, to learn more. And you can go to DeckerRetirementPlanning.com under the heading of Safer Retirement Education. There are 12 different things you can download. And it's really just information for you to learn more about retirement. A great place to start would just get Brian's book on retirement, the Decker Approach book. That's one of the 12 things you can download right there on the website, Decker Retirement Planning under the heading of Safer Retirement Education. And, of course, you can always call them at 833-707-3030 if you want to know how all of this Brian talks about every week, how it pertains to you and your situation, 833-707-3030. I'm Mark Elliott. Glad you're with us today. All right, Brian, you're going through that distribution planning process, having a plan, number one, risk reduction, number two, and then taxes are a big, big part of retirement planning in today's retirement world. And I know you got a lot more in the tax category yet to go.
Yes, how to properly do a Roth conversion. So we have buckets 1, 2, 3, 4, and 5. Those are laddered principal guaranteed accounts. Those accounts we're drawing from, so it does not make sense to use those in a Roth conversion. Roth conversion, you want to have in the highest growing account that lasts the longest. And so you would not want to do those in accounts that are growing not at the highest rate and also not at the having them go the longest. And so this is something that we want to make sure that we do for clients. So what we do is we look at their gross income, we subtract out their standard deduction, or if they itemize to get an AGI, adjusted gross income, then we look at their taxes, and without raising their bracket, we look at see how much room they have in that bracket. We ideally want to stay out of the 32% bracket if possible, but then we do the Roth conversion. And over 5 to 7 years, we get that done in the risk bucket only. The risk bucket is where we do the Roth conversion. So we know to the dollar how much money should be converted from IRA to Roth. Now, this year, 2024 and 2025 are very important because tax rates will go higher in 2026. The Trump tax cuts sunset. And so if Congress does nothing, which they're very good at, if Congress does nothing, then we're going to see tax rates go higher, about 3% higher across the board. So that's something that we want to take advantage of. And that's how we do it. And that's where we do it for the Roth conversion. But here's some others that I'm just going to go through very quickly. If you have a spike in income in 1 year because you exercise stock options, we use the donor advised fund where we can combine 5 years of charitable giving into one for an offset. If you don't want to pay capital gains on a highly appreciated property, a stock portfolio, we use the charitable remainder trust. That is an offset and allows a way that you can eliminate capital gains taxes. What if you have a big age difference in marriage where your spouse is 10 years or so younger? If we have an age difference and you've got a 401k, we definitely use the Quadro. The Quadro allows us to take half that money, send it down to the younger spouse, and have a lot more time to do Roth conversions on that money. Do you not want to pay state or federal estate taxes? We use the ILIT, the Irrevocable Life Insurance Trust, to offset and pay about 25 cents on the dollar for those federal and state estate taxes. That's a strategy that we use for that. Do you have highly appreciated company stock in your 401k? Then we use net unrealized appreciation for that. Do you have children that you want to send money to? If you have grandchildren that you want to send money to, there's a generation skipping tax of 48% that you need to deal with. But we can get around that by using a dynasty trust. A dynasty trust is where it's actually two things. It's perpetual and it's per stirpes. It stays bloodline. So you're able to peel off a part of your estate and send it down to your children and grandchildren and their children and their children and their children. It's a legacy account that you can write anything you want as far as use of funds. A percentage goes to college tuition, a percentage goes to first marriage, a percentage goes to down payment on a house. You can benefit and bless the lives of your legacy by using a dynasty trust and not pay the 48% generation skipping tax on that. Then if you have rental real estate, did you know that we can employ cost segregation strategies so that you can accelerate the depreciation and have 100% tax-free revenue stream from your rental properties? And there's more. I'll just spend one more. The GRAT. What if you have in your retirement years, 60s or 70s, and you've still got great ideas to start businesses? Well, go do it. Knock yourself out, but have those businesses start in your children's estate. You run it, you have access to the money, but let that growth be not in your estate. Use the GRAT so that you've got that growth in your kids' estate. So those are some of the tax minimization strategies. And if you're keeping track, that's number 3. Number 1, We're talking about the 6 key parts to a final retirement plan. Number 1 is to have a plan. Most people don't. Earlier in the show, we talked in detail about what a plan is. Number 2 is risk reduction. There's 3 parts to it. Quantitatively lowering your risk from a ridiculous 60-40, 70-30 portfolio. Who does that? But bankers and brokers recommend that. Our recommendation is quantitatively shrink that to 25% and eliminate interest rate risks. Bond funds make 0 sense in a rising interest rate environment, and strategically lower your risk by using momentum strategies that are designed to make money in up or down markets. We went into detail of that earlier in the show. And now we talked about risk reduction being number 3 and went into details about some of the risk reduction strategies that are available. Number 4 is portfolio optimization. Every part of the portfolio is optimized. We're a math-based firm. We are also fiduciaries to our clients. So we don't say, well, Mark, here's 4 or 5 mutual funds. They're not the best, but they'll do. We don't do that. We would never do that. We don't even think that way. So what we do is we go to the databases. The Wink database allows us to see the highest earning principal guaranteed offerings from banks and insurance companies. On a monthly basis, we check that out. And on a quarterly basis, we look at the 5 different databases on the stock side. We look at the Morningstar database, largest database of mutual funds in the world, the Wilshire database, largest database of money managers in the world, and 3 others. And we want to find out the highest returns for each part of the portfolio. Emergency cash in bucket 1 are money market accounts. Where can we find the highest money market rate? Right now, it's close to 5%. Your banks are paying 1. Number 2, where can we get the highest returns on 3 and 5 year CDs? Is it banks? Is it insurance companies? We find out. We lock those in. Number 4 and 5 are 7 and 10 year principal guaranteed accounts. Well, the ones that we are using, some of these are AI indexes that we're using, and we're seeing in the last 10 years average annual returns in the double digits. These are principal guaranteed accounts. That's where we're getting the highest returns. And then we talked earlier about the risk strategies. Of all the different risk strategies, the biggest study ever done is in Jake O'Shaughnessy's book, What Works on Wall Street, page 367, Appendix A. Since 1950, what strategies have produced the highest returns? Well, it is momentum. It is sector rotation. It is relative strength, but they're the same thing. We talked about that earlier in the show. So every part of our client's portfolio is optimized. Now, eventually, there's going to be something better. And we, being a research firm and a math-based firm and fiduciaries to our clients, will be on it. We never want to have a client say, well, XYZ company has better fill in the blank. We never want to do that. We're on top of it. We want to make sure that we've done the research so that no client ever says that to us. So portfolio optimization is what really sets us apart. Number 4 and 5, I can go over quickly. Number 5 is the focus of all of our services is to maximize the net monthly income for our clients. That is very, very important to us. And then number 6 is fee minimization. Most people in the United States, they pay 1% in fees to their for their portfolio services. Our clients typically pay 2/3 or 3/4 less. There's no management fees on principal guaranteed accounts, buckets 1, 2, 3, 4, and 5. And on the risk bucket is only about 25% of the portfolio. So when we factor in the management fees as a percentage of the whole portfolio, it works out to be about 0.25 or 0.33, far less than what most people pay. So fee minimization is very important to us. So those are the 6 key points of a final retirement plan. That's very, very important that you have those down. Whatever firm you're working with, look at those 6 key points. Do they have a plan? Is there risk reduction? Is there tax minimization? Is there portfolio optimization? Are they focused on maximizing my net of tax monthly income? And is there fee minimization as part of it? Those 6 are all very important.
So again, the opportunity is for you just to talk with Brian and the team at Decker Retirement. Find out how all of this affects you. How is your portfolio set up? And is it set up the right way for you? Maybe you're taking too much risk. Maybe you're not taking enough risk. Everybody's situation is unique. And that's how Brian and the team look at it. How can they help you be in a better position? 833-707-3030 is the number. Again, no cost for this. There's no pressure. There's no obligation. 833-707-3030. Might be the most important phone call you make. 833-707-3030. Brian, as always, enjoyed it. Enjoy the rest of the weekend. We'll do it again next week.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.